Welcome back to the Keiser Report. I'm Max Keiser. You know what this is? This is 24 karat gold investment jewelry. This is something very special, and we're going to be talking about this shortly. But first, let me introduce Roy Sebag, the founder of Gold Money and Monet. Roy, welcome back.
Thanks for having me, Max.
Great to see you again, sir.
You too.
Okay. Now, it's great to have you on because you travel the world. You're well-studied economist, entrepreneur, deep thinker. So we like to pick your brain as well as get your thoughts on some late-breaking news. Now, interest rates have been rising. Trade wars are breaking out everywhere. Why hasn't gold jumped on the safe haven buying, Roy?
I think it's because rates are actually rising, and a lot of the fears that the gold camp have had about the rates rising causing debt deflation, asset deflation haven't materialized yet. That's the operative word, yet. Thus far, we've seen the Federal Reserve raise rates very aggressively. The 2-year has gone from 0.7% to 2.7% in about 10 months. And we have seen little to no reaction in terms of the debt markets. They've tightened up a little bit, but equity markets are still roaring. And we've seen some really, really good economic news out of the United States, stimulated in part by some of Trump's policies in terms of taxes. We've also seen a big uptick in capital spending on the part of companies, something that people have been waiting for a long time. So I think that ultimately these rates rising will cause a great debt deflation and recession, and it'll probably start around August of this year when people start to see the size of the deficits on the U.S. Budget spending compared to their historic tax revenues, because of course their tax revenues now begin to decline significantly in August. Okay,
so tax revenues are on the wane, and let's talk about this idea about rates rising, because I just read Naomi Prinz's book. She has a book out called Collusion.
Yeah.
She's talking about central banks colluding, something that we've talked about, something that's known pretty much in the community, that when one bank is tightening, others will get, more accommodative, easing. ECB, Bank of Japan, Federal Reserve Bank. So is this cycle what's being called quantitative tightening in the U.S.? Is it being completely offset by other central banks doing the reverse? And so the net amount of money printing in the world continues to go up, or is this a genuine contraction?
It's a great question. I would argue that the answer is no. You see, Trump has been a wrecking ball, not just in terms of his U.S. political race. He's actually reminded countries that they have to be selfish again. We're seeing it in trade. We're seeing it in economic policies. And I think we're even beginning to see things, say, in Italy, where it's starting to break apart from the EU. It's talking about nationalization. It's talking about a different currency. So I would argue that the great fear in terms of the next time there's debt deflation or asset deflation is that you will not see a concerted effort on the part of the central banks, because these various countries no longer have that type of political will. That sort of game of, I'm loosening, you're tightening, I'm tightening, you're loosening, I can't really tell, that only works if there's a global coordinated elitist effort, like what Christine Lagarde fielding phone calls between everyone. But I actually think that Trump has wrecked that game theory. That game theory no longer exists. So what the U.S. is doing is playing 4D chess. They're raising rates very aggressively. They've lowered taxes, and now they're starting to take out a sniper rifle and shoot all of their trading partners with very, very intelligent reciprocal trade policies.
Okay, when Trump says "Make America Great Again," a lot of people were saying, it sounds isolationist. There's another side of the argument, as you are describing. He's clearing the board and saying we want to compete globally and we want to reset the table. So it's not really isolationism. It's about engaging the world economically and with trade, but with a whole new set of rules.
Well, he's 100% right in that the trading partners of the United States have been taking advantage of the U.S. for the last 30 years, and it seems to be attributed towards very, very dumb trade deals. We know that's true in the case of trade between the EU and the United States. So all he's doing is he's pushing for reciprocity, but he's realized very early on that his counterparties are not taking him seriously. So now I think that he and Pete Navarro, who's the economist that's advising him, are getting even more aggressive. But the key is, Trump said this once, and I think it's a very intelligent comment. He said, you can't lose a trade war when you already have $1 trillion in trade deficits. And that seems to be something that no one else has quite figured out.
Isn't it a variation on the old joke? Like, if you owe the bank $100, you got a trouble, but if you owe the bank $100 billion, it's their trouble, right?
I don't think it's the same thing, because remember, trade is a function of flow. It's not debt. So with debt, if you owe the bank debt, you have to pay it back. Trade, everyone wakes up in the morning and decides at that moment if they want to cooperate with each other. They don't have to. And I think that the U.S. has been abused for a very long time. So if we go back to this whole story of rates rising, right now we're seeing economic growth in the United States. But remember, there is another side of this coin, which I think is very relevant to our conversation. Over the last 8 years, since the Federal Reserve began to engage in extraordinary monetary policy, we've seen a tremendous amount of new debt being issued, something in the order of $20